Hello and welcome to KSA Tax Expert. This is Imran Ahmed. The purpose of this channel is to provide updates about KSA tax development and practices to support tax education and development of Saudi nationals. This is my tribute to Saudi society, where I spent almost 16 years of my life. So let's start our discussion on Saudi Arabian tax and zakat.
Today, we are going to have discussion about Saudi Arabian corporate income tax. Persons who are subject to corporate income tax are defined in Article 2 of Saudi tax regulations. A resident capital company, like a joint stock company or a limited liability company with respect to non-GCC shareholdings, a resident non-GCC, non-Saudi person who is doing business activity in the kingdom, a non-resident who does business activity in kingdom by a branch or a permanent establishment. The basis of settlement of corporate income tax. The shareholders, owners or partners are subject to tax, not the entities. In Saudi Arabia, the shareholders are subject to tax and not the entities. This makes the tax system of Saudi Arabia different than other countries. As I explained before, an entity would be subject to tax or zakat. It depends upon the nationality of the shareholders. It means the taxes are imposed on shareholders, not on the entities, because the nationality of the shareholders is the deciding factor to impose tax or zakat. The entities are responsible for preparation and submission of tax returns and settling tax liability on behalf of shareholders. Now, in Saudi Arabia, the worldwide income is subject to tax. What it means? It means if an entity is having branches or operations outside Saudi Arabia, the results of those branches and operations would be part of the tax base of a resident entity in Saudi Arabia. As far as rate is concerned, there's 20% corporate income tax. With respect to natural gas investment activities and oil and hydrocarbon activities, there's a specific tax rate of 30 to 85%. For corporate income tax purposes, the citizens of GCC countries are treated as Saudis. What it means? It means these GCC nationals would be subject to corporate zakat and not corporate income tax. Profit subject to tax is calculated by making adjustment to accounting profit or accounting loss. Article 13 of tax law and Article 10 of bylaws provides details of non-deductible expenses. Certain expenses which are disallowed, which are non-deductible according to tax regulations, those are the expense which is not connected to earning of taxable income. So if an expense is incurred and if that expense does not relate to earning of taxable income, that expense is not deductible. Amounts paid or benefit offered to shareholders, partners, or their relatives with respect to salaries and wages, to the extent it exceeds the market value, it exceeds the arm's length value. So if there's any benefit which is paid to shareholders and partners or their relatives, we need to see that the payment is in line with the market value. So whatever exceeds the market value would be a disallowable cost. Most common disallowable costs are provisions. Provisions are disallowed when it is created. However, these provisions can be claimed as an expenses when these are utilized. For example, an entity makes a provision for end of service benefits. So during the year in which this provision is made, it's a disallowable cost. However, when this end of service provision is utilized, when it is paid to the employee, then in that year, it is claimed as an expenses. Any general or unspecified accruals which do not have any basis or supporting, that is disallowed. With respect to depreciation, there is a different method and basis and rate for computation of depreciation in tax. So whatever depreciation is charged in the accounts, in the financial statements, is disallowed, and we need to recompute the depreciation as per tax regulations, and that depreciation as per tax is allowed as an expenses. Losses or gains on disposal of depreciable assets, it's not allowable expenses. Income tax paid in the kingdom or in any other country is a disallowable cost. Fines and financial penalties paid or payable to any party in the kingdom. However, it does not include those fines or penalties paid for breach of contractual obligations. The recreation and entertainment expenses is a disallowable cost. Interest is allowed to extent of certain limits. In case the goods or services are supplied by or provided by affiliated party or related party, the amount which exceeds the fair market value or arm's length value is a disallowable cost. Contribution to foreign social insurance or pension fund or employee's share of GOSI, if it is paid by the taxpayer, it's a disallowable cost. Unrealized exchange loss is not allowed as an expenses. Repair and improvement, there's a limit of 4%. So the amount spent on repair and improvement is allowed to the extent of 4% of the value of fixed assets as per tax base. Whatever amount is disallowed is capitalized and claimed as a depreciation in future years. The expense of a natural person, it is considered as a drawing, but not as an expenses. Payments made to head office abroad by KSA branch. In case of a branch, if that branch pays royalty or commission to its head office outside, it's a disallowable cost. If a branch pays loan charges, interest, or any other financial charges, that would be a disallowable cost. However, this article does not apply in case of branches of banks. So if a branch of bank is paying loan charges or interest or any other financial fees to its head office bank outside, that would be allowed expenses. The indirect administrative and general expenses allocated on estimated basis. So if an expense is allocated by head office, which is based on estimation, that would not be allowed as an expenses. If an entity is having agreed assessed brought forwarded losses, those losses can be adjusted without any limitations or restrictions in the number of years until the time all the losses are utilized. There's only one restriction, that the adjustment on account of brought forwarded cannot be more than 25% of profit for the year. So what it means? It means even if an entity is having significant amount of brought forwarded losses, that entity would be required to settle tax on at least 75% of the taxable profit, because the adjustment is allowed only to the extent of 25% of profit for the year. Now, this is a proforma computation of taxable income. It will give you an idea how the taxable profit is computed. So we start from the results as per financial statements. If there's a profit, we'll take profit. If there's a loss, we'll start from the loss. Then we need to add the expense which are not allowed, the expense which are disallowable in accordance with Saudi tax regulations. Then we will claim or we will deduct those expenses which have not been charged as an expense in the financial statements during the year. However, those are allowed for tax purposes. I will give an example, and that example is when the provision is made, it's disallowed, but when it is paid or utilized, it can be claimed. So in year, when the provisions are paid or utilized, although these are not charged as an expense during the year, however, based on tax regulations, those can be claimed because provision is allowed when it is utilized. Now, if there's any exempt income or the income which is not subject to tax, we need to take this out. Then we will arrive at adjusted profit. And if an entity is having a brought forward losses, then we need to make adjustment on account of such losses to the extent of 25% of profit for the year. Then we will come to a taxable profit, and this taxable profit would be subject to 20% corporate income tax. This concludes my discussion for today. I hope this video is informative and useful to you. If yes, please share and subscribe. If you have any questions or doubts, please feel free to connect me through email or mobile, or write your questions in comment box. I will come back to you. Thank you very much. Thanks for watching.